Hello, welcome back. Mike from Canavan Wealth. It is Tuesday, September 5th. I hope everyone had a good Labor Day weekend. Let's jump into it. Market's down about 1/4% today. Really not too bad. It's been level for the last couple of days, but over the last 5 days, we are up about 1.7. So continuing to kind of see this rally. When will we get back to the kind of recent high here at 19.5? We're still about 1.5% off. Who knows? We'll see soon. Um, First article here. This is really interesting from a financial advisor standpoint because this is a change from a major paradigm shift over the last 20 years. So the relationship between stocks and bonds, which is going to be summarized in this chart, in that, you know, over most of investment history, when stocks have been up, bond yields are down. When bond yields are up, stocks are down. That's that's inversely correlated. That has drawn to this world where bonds provided a downside protection from stocks. You often invested in both because when your stock portfolio went down, your bonds went up. Then you could rebalance, buy back into the stocks when they're low. But for the last 20 years, which is from here, back to, kind of 2001 to recently, kind of in 2022, that has not been the case. When stocks have done well, bonds have done all right, and when stocks have been down, bonds have, yields have been down, performed poorly, which has created this very interesting world where they still regulate around how much someone should be in stocks and bonds, and that's kind of directly correlated to how aggressive they are. I've had clients all through this who are like, I think I should be more conservative. Why aren't we more in bonds? And you have to kind of explain that, like, bonds don't work the way that they used to, or the way they did for your parents. There's been this, as the article, this paradigm shift, but it has recently shifted back. So this line here now has driven us, you can see it kind of into inverse correlation back in the way it was in the 90s, and really most of investing history, if you go past that, in which bonds are starting to provide that downside protection. I think that's largely because interest rates have come back up. The real question is whether this is going to continue for the next 10 years. If, for example, we are unable to get interest rates below the Fed's stated goal of 2%, if inflation gets sticky, which there are some indicators it may, then we may go back to this world of kind of, the 90s instead of the last 20 years. And all of this is just a giant lesson in the past is very important to understand, but at the same time, we need to understand that the future may not look like it, and we need to be flexible and nimble and learn the lessons quickly as they come, right? If you did not learn in the first 10 years of this shift that bonds are not providing the protection that they once did, you really could have lost your shirt over the next 10 years, where interest rates were virtually nothing. So if you're invested in bonds, not only did you not get great returns, but they provided very little of the downside protection that they did in the past. So really interesting article if you want to read through it. Okay, next one. Exact age when you make your best financial decisions. According to these kind of studies, that's 53 to 54. This does not shock me at all. I talk to a lot of clients who talk to me about their kids because we talk generational wealth. And I hear over and over, my kids in their 30s and 40s, they just haven't gotten it together yet. They haven't kind of figured out this whole financial thing. And I often go back to them and say that's perfectly normal. There's nothing abnormal about your kids if they haven't have gotten it together by their late 30s, early mid 40s. And this would imply that you really won't even get it together until your 50s. And that's because understanding investments, the world of finances and money, takes time and experience. Often in your 20s, you don't have the money to gain the experience. You generally start to get your life together kind of in your 30s and early 40s, where it's the first time where you actually have the assets in order to start learning some of those things. So, um, unfortunately, once you get to your 50s, now you're 10, 20 years out from retirement, and it can seem fairly dire, but this is kind of the normal transition. But why it's so important that, as parents, financial advisors, that we work and talk with younger clients, I often spend a lot of time, just kind of talking with and coaching my clients' adult children, so that they can ask questions that they may not understand, that they can get really conflicting information from YouTube videos and all this stuff that's really just trying to sensationalize things and sell them on various strategies. So talk to your kids about money. It is so, so important. I have a lot of videos that can help all over the channel for that. I'll link those probably at the end. All right. And then this, I could not help but cover this. I'm kind of a nerd. So this is the India moon mission that recently landed on one of the poles of the moon. And they did it for a shocking $70 million, which is absolutely crazy in my mind. There's a fantastic quote down here that says India's first Mars orbiter in 2014 came with a lower price tag than the 2015 blockbuster The Martian. They landed on the moon for less than it cost Hollywood to make movies about the moon. Obviously, there was a Mars mission and then the most recent moon mission. It goes into understanding how India has been able to run a very frugal space mission that has changed from operating literally out of shacks and old churches into a truly competitive space agency that certainly piggybacks on a lot of what NASA and other programs have learned over the years. Um, but it nonetheless is a relevant player in the space industry. You can see here that this is an interesting chart. Obviously, we know that the U.S. spends more than India on space, but this is actually per GDP. So this takes into a size the economy. We spend almost 10 times more than India, and yet they're still a relevant force. Um, I can I think a lot of people can understand that as America, we don't necessarily optimally spend money. I certainly saw it when I was in the military. We have an incredibly capable military, and yet I saw such incredible waste from my perspective. I understand that I don't see the full picture while I was there. So I would like to see that we could start learning something from these countries that are starting to be competitive. All right, that is really it. Kind of an average week when it comes to the markets. These three articles I thought were really pretty interesting. I will, of course, link those in the description below. I hope this has been informative. I will talk to you soon. Thank you.